Okay, this video is for Chapter 3 of our Porter and Norton textbook for Introductory Financial Accounting. And in this one, we're going to be talking about the mechanics by which the accounting information gets processed. So in the first two chapters, we focused on the result of that processing. Now we're going to talk about how the processing actually gets done. And when we're doing the mechanics, we always want to keep in mind that we have to keep the accounting equation in balance. That balance sheet equation that we use, assets equals liabilities plus stockholders' equity or owner's equity, whichever you want to call it, the assets have to always equal the total of those liabilities and equity. So we're always going to be looking for the effect of the processing that we're doing on that accounting equation to make sure that it stays in balance. Let's look at some examples. So let's say we start a brand new company, and often the first thing that happens with a brand new company, usually what happens first, is that the owners of the company invest some money in the business. So they contribute some capital to the business. In this case, we've got Karen and Kathy, and they are incorporating this business, and they're each investing $50,000 in the business. And in return, they're each receiving 5,000 shares of capital stock. So that means the company as a whole is going to get $100,000, and they're going to have issued 10,000 shares of capital stock. What we're going to do is look at the effect on the accounting equation of what's happening here. And we're going to say, okay, the company basically is increasing its cash by $100,000, and it's increasing the contributed capital portion of stockholders' equity, which is capital stock, by $100,000. So you can see that we've written out the accounting equation there, and then we've put in some subheadings, some individual accounts under the different categories that they fit in. And those were done ahead of time, knowing what the examples were going to be. You could always add additional asset accounts or additional liability accounts or additional equity accounts if you were doing this for another company. The next transaction that this company engages in is they buy some property for $200,000, and the seller has agreed that they can pay them in the future. So they accepted a 5-year promissory note. That means the company now owes that $200,000, and they will have to pay it in 5 years. And so that would be recorded as a note payable because it has a promissory note underneath it. That promissory note is a source document that represents a note payable. And in this case, the property consists of both land that's valued at $50,000 and a building that's valued at $150,000. And so here we're going to see an example of a transaction that doesn't just have the same amount to two different accounts, but rather we're going to record two different assets. And so we see $150,000 as an increase to the building account and $50,000 as an increase to the land account. And then the total of those is going to be added to our notes payable on the liabilities and equity side. Again, anytime we add something to the asset side of the equation, we either have to subtract something also from the asset side to keep it in balance, or we have to add something to the other side. And in this case, we increased our debt when we increased those assets, and so we add the $200,000 to our liabilities under notes payable. The next transaction this company engages in is they buy some equipment, and it's $20,000 worth of exercise equipment. Treadmills, barbells, stationary bicycles. That sounds like things that will last longer than a year, so those are going to be long-term assets. And in this case, the supplier agrees to accept payment in full in 30 days. So this is not a note payable. That doesn't say anything about a promissory note, and the typical kind of credit agreement in businesses that allow credit is a 30-day payment. So this is simply going to be accounts payable that we're going to use for this transaction. So we are going to increase our assets. In this case, the equipment asset increases by the $20,000. And then on the other side of the equation, accounts payable is going to increase by $20,000. And you'll notice if we total everything up, we're still in balance for that equation as a whole. Next, the company sells monthly memberships on account. So they sold 300 memberships for $50 each for a total of $15,000. And the members have until the 10th of the following month to pay. This is going to represent money that we've received from, or I'm sorry, not money. We haven't received the money yet from these customers, but we have basically earned some revenue. And so the revenue, notice the revenue doesn't appear on our balance sheet equation because a revenue is an income statement account, right? But that income eventually is going to flow into the balance sheet. Remember that we showed the order of how we create the financial statements, and we make the income statement first, and then we make the statement of retained earnings, and then that flows through onto the balance sheet. And so we're only looking at the balance sheet effect of this, so we have to remember, oh yeah, that revenue flows through to net income, which flows through to retained earnings. And so that's where you see this $15,000 being added to our retained earnings here on our accounting equation. And then the fact that these customers haven't actually paid us the money yet, even though we have earned it, means that then it needs to be recorded as accounts receivable for $15,000. So that's money we expect to receive from our customers within 30 days, which would be by the 10th of the following month. Next, we sell some court time for cash, and so here again is revenue that the company is earning, and in this case it's not accounts receivable, but they actually paid us the cash. So it's going to look similar to that last one, but notice that on the asset side, instead of increasing accounts receivable, we're going to increase cash, and we're still increasing retained earnings on the stockholders' equity category under the right side of the equation, and for the same reason as we mentioned before, that revenue is going to flow into net income. It's going to increase the net income, which is going to increase the retained earnings on the statement of retained earnings, and then that's going to flow through to the stockholders' equity section of the balance sheet. Next, we're going to pay some wages and salaries, and payment of wages and salaries is considered an expense. And so what we're going to do there, expenses are also part of the income statement, but in this case they decrease our net income, and that therefore decreases the retained earnings. And so you see it being subtracted from the retained earnings on the right side of the equation. And because we're paying it in cash and not just incurring it as a payable, we are decreasing the cash on the asset side of the equation as well. Next, we pay utilities. Utilities are also an expense of the company, and so here again we're going to decrease our retained earnings on the right side of the equation to reflect the fact that the expenses decrease our net income, which decreases our retained earnings. And our cash is also decreasing by the amount that we paid, $3,000. When we collect accounts receivable, we are receiving cash from our customers, and so therefore we're going to increase our cash account on the left side of the equation. And in this case, we already recorded the revenue associated with these members. We already recorded the membership fees as accounts receivable, so we're not going to record the revenue again. That would be double counting it. Instead, because it says this is in payment of their accounts, that means we've already charged them for this stuff before, and we would have recorded the revenue when we charged them. And so in this case, we're simply then going to decrease the amount that they owe us, because they don't owe us that anymore because they just paid us. So we're increasing the asset called cash, we're decreasing the asset called accounts receivable, and notice that the net effect on our assets is zero. Our total assets stays exactly the same as it was before at $327,000. And so be careful with questions about something like that, because they might say, what is the overall effect on the accounting equation? And the overall effect is zero. So be careful what they ask you about when they ask about a question like this. It could be that they're showing They might want the effect on the cash asset. That would be an increase. They might want the effect on the accounts receivable asset. That would be a decrease. But they might ask for the overall effect on assets, or they might ask for the overall effect on the equation as a whole. And the answer in both cases is 0, because the one increase nets against the decrease for a total effect of 0. Okay, payment of dividends is what happens next. And so they're basically paying themselves as the owners. So it's $2,000 in total. Dividends is also not an account that appears directly on our balance sheet, but we do know how it affects retained earnings based on our statement of retained earnings. And so our statement of retained earnings, to refresh your memory, is beginning retained earnings plus net income minus dividends equals ending retained earnings. So we know that those dividends are going to have a negative effect on stockholders' equity, so we show the subtraction from our stockholders' equity. I went a little too far, sorry. There we are, back to where we needed to be. So we show the subtraction from our retained earnings, and we also show the subtraction from our cash, because they are going to decrease their cash by the amount of that dividend that they paid. Next, we're going to use up or down arrows to state the overall effect, increase or decrease, on each component of the accounting equation. And so we're going to look at exactly, these aren't the same transactions. These are different transactions. So the first one, we're providing services to customers on account for $12,000. If we're providing those services on account, what that means is we're doing the services, that's the provide services part, but the customers aren't paying us yet. We're extending them credit. And so what's going to happen here is our assets are going to increase, but it's not the cash asset, it's the accounts receivable asset. And so we're generating accounts receivable when we're earning this revenue. We are earning revenue, and therefore the revenue is going to have a positive effect on our retained earnings by increasing our net income. And so our stockholders' equity, where retained earnings is a component, is going to increase by the $12,000. The second one then says receive cash from the services we provided on August 1st. So we saw the August 1st transaction up here. Now we're seeing the actual receipt of the cash from our customers, and it's for $8,000. In this case, our cash asset is going to increase, but our accounts receivable asset that we recorded up in Part A is going to decrease. And so we're going to show that we've got a decrease in accounts receivable offset by an increase in cash, and therefore the overall effect on that accounting equation is 0. And a commercial break. What does the computer acronym GIGO stand for? And the answer is it stands for garbage in, garbage out. If you don't put good stuff into the computer, you won't get good stuff out. Okay, commercial break is over. Let's state the overall effect, increase or decrease, on each component of the accounting equation, again with up and down arrows. So let's pay worker salaries for the current period, $1,400. Those worker salaries are an expense of the business, and so we're going to show the fact that that means our net income is going to go down. That means our retained earnings is going to go down, so that has a negative effect on stockholders' equity. And it also has a negative effect on our assets. So we're going to show down arrows in the equity, and we're going to show down arrow in the asset. Another commercial break. Who produced 2 booklets for comic relief under the names Newt Scamander and Kenilworthy Wisp? Most of you are old enough to have watched the Harry Potter movies and read some of the Harry Potter books. The answer to this question is, in fact, J.K. Rowling. You would have seen both of these booklets in some of the Harry Potter books that were there. These were books that Harry owned. Okay, commercial break is over. State the overall effect, increase or decrease, on each component of the accounting equation. So we're doing the same thing we've been doing. This time we're recording the fact that we've provided services to customers on account. The providing services means we earned revenue. That means our stockholders' equity is going to go up through retained earnings going up because revenues increase net income, which increases retained earnings. And we're also going to see our assets go up, in this case not the cash asset, but the accounts receivable asset. Another commercial break. Who met Cyclops on his third voyage? The answer is Sinbad. Okay, accounts and the chart of accounts. So we looked at the overall goal of recording these transactions, but those were not the actual mechanics of how it works. To make it work, we have to understand some of the components of the double entry accounting system. And the main component that we have are accounts. The accounts are records that are used to accumulate amounts for each individual asset, liability, revenue, expense, and component of stockholders' equity. So we'll have accounts for things like cash, accounts receivable, accounts payable. We've seen those, basically all those line items on our financial statements that we've talked about. Each line item represents a different account in our system. And when we list all of those accounts, just listing the names of those accounts, we call that a chart of accounts. So a chart of accounts is basically a numbered list of all the accounts that the company uses. They're typically numbered according to what type of account they are. So for example, all the asset accounts might start with the number 1. So we might have number 1, 101, 102, 103. Each of those would represent a different asset account. Depending how big the company is, it might even be 10,001 or 100,001, but it will have a 1 on the front end of it to represent assets. And then the liabilities might have, or even sometimes the 1s represent current assets, and then the 2s will end up will represent long-term asset accounts. The 3s will represent current liability accounts. The 4s will represent long-term liability accounts. Then the 5s might end up representing revenues, and the 6s might represent expenses, and the 7s might represent dividends. At any rate, when we have that numbered list, we call it a chart of accounts. Another component we have in this double entry system is a general ledger. And the general ledger is basically the collection of all of those accounts. And it could be in a book format if it's a manual system. We don't see those very much anymore. More likely it's going to be a file on a hard drive, or it's going to be some other kind of a device that contains all the accounts. We also have a general journal, and it's in that journal that we enter all the transactions in chronological order. Again, it could be a manual general ledger in a paper book. More often, it's a file on a hard drive or something like that. The double entry system is the process of recording the transactions such that our total debits stay equal to our total credits, as we just saw in the examples we went through where we were keeping it in balance. And what happens is we make the entries in the general journal, and then we post them to the general ledger. And so, let's see if I can get back to there. I also want to talk for a minute about T accounts. T accounts is an artificial picture that we use of showing basically a general ledger account. So it's a way of showing what's getting posted as debits and credits to a single account. It's an informal tool. It's not a formal part of the system, whereas the journal and the ledger those are formal components of the double entry accounting system. A T account is something that we use as a shortcut for thinking about the overall effects on an account, and we'll look at those a little bit later. Okay, so the idea of posting is transferring amounts from a general journal to the ledger account. So we enter the transactions in the journal first. Those are in chronological order. But if all we did was post things to the journal, if all we did was enter them in the journal, we wouldn't be able to very easily pull out, okay, if all these things happened, what do we now have in total in cash? Or what's the total that we now have in accounts receivable? And so the idea of posting the transactions from the journal to the ledger is basically to help us to categorize or summarize the total effects on each individual account. So the journal gives us in chronological order, the ledger then gives us all of that summarized by the different accounts that were affected. Here's an example of what it looks like if we were using a manual system. So you'll notice that first we would record these entries in this general journal. So we would first make this journal entry to debit accounts receivable and credit membership revenue to represent the sales of the memberships that we saw earlier. We also then are making a journal entry to debit cash for $5,000 and credit court fee revenue for $5,000 to indicate the court time that we sold for cash. And we would continue on with all of those other entries that we talked about, making those in the general journal. So we do them in chronological order that they happened. And then the next thing we do is we take each of those transactions and we post it to the general ledger accounts. And so in the cash account for that second transaction, we're going to post the $5,000 increase to cash. And notice that we already had posted before this capital stock that we sold to the two owners. So we see that there was already a debit to that account of $100,000. And now when we post this $5,000 down into it, we then increase its balance to $105,000. The court fee revenue side of it, we credit to the court fee revenue account. And notice that in this posting reference column, we're showing where did this entry get posted from. So it refers back to the general journal and page 1 of that general journal. So that's what the GJ1 stands for. In the journal then, we use the posting reference column to show that we did post the entry to the general ledger account. And so the one that's posted in the posting reference column for the cash shows that we did take that $5,000 and post it as a debit in the cash account, which is account number 1 on our chart of accounts. And so we see that that's what we put in the posting reference column. For the court fee revenue, on the other hand, we're posting that as a credit to account number 44, which is our court fee revenue account. And that's why we put in the 44 in the posting reference column in the journal. So that's how the mechanics of making the journal entries and posting them to the ledger work. Now, it's kind of cumbersome to show all of those ledgers and accounts, the ledgers and the journals in that long format that we just saw. And so a lot of times we use a T account to informally summarize for any individual general ledger account what's going on. And so you'll see that we make a T for the T account, and then at the top of it we put the account name. And the left side, we're not actually going to write the word increases on the left side or decreases on the right side, because that actually depends on what account it is, which side increases with a debit, or which accounts increase with a debit and decrease with a credit, or vice versa, which we'll get into in a minute. For the cash account, because it's an asset, the left side of the cash account shows that it increases, and the right side of the cash account show any decreases in the cash. So in this case, what you can see is the cash account increased by the $100,000 investment by the owners, the $5,000 that we received in court fees, and then the $4,000 that we collected from accounts receivable, if you think back to the example we went through at the beginning. On the other hand, we had wages and salaries and utilities and dividends that all decreased our cash. And so those are showing up on the right side of this cash account. And then we simply, let me get back there. Then we simply take the total of those decreases away from the total of the increases to get the balance as $94,000. Now, that brings us to the idea of debits and credits. Debits and credits are ways of recording the increases and decreases in the accounts, and you're going to have to very quickly become knowledgeable about which accounts have debit balances and therefore increase with debits and decrease with credits, and which accounts have credit balances, which means they increase with credit entries and decrease with debit entries. No matter what kind of an account it is, it will have a left side that represents the debits to that account, and it will have a right side which represents the credits to that account. Whether the debits or the credits increase the account depends what kind of account it is. Basically, asset accounts increase with debits. They have debit balances and increase with debits. Our liabilities and owner's equity accounts have credit balances and thereby increase with credits. Now think about our accounting equation, which has assets on the left side, liabilities and equity on the right side. That shows you the debit and credit translation. So our assets are on the left side, and the left side of an account is the debit side, and therefore asset accounts have debit balances and increase with debits. Liabilities and stockholders' equity are on the right side of the equation, and that means that they're going to be credit balance accounts. The right side of an account is its credit side, and so they're going to increase with credits and decrease with debits. Now, so for some of you, that's going to fall right out. You're going to go, oh, okay, assets are on the left side is debit, therefore assets have debit balances. Liabilities are on the right side is the credit side, therefore liabilities have credit balances. Stockholders' equity is also on the right side of that equation. Right side is the credit side, therefore they have credit balances and they increase with credits. Others of you, that's not going to be as easy to see and retain, and so you'll just have to memorize for a while which accounts have which types of balances. Now that we add some complication when we think about what about the revenue accounts and the expense accounts and the dividend accounts. Those are not part of the accounting equation directly, and so to figure out the rules for debits and credits for those accounts, we have to think about how they affect the accounting equation. So here again we see our accounting equation, assets equals liabilities plus stockholders' equity. And so we're going to show, we see then that the assets increase with debits, the liabilities increase with credits, and the stockholders' equity increase with credits. To be able to tell the revenues, expenses, and dividends, then we have to think about how they affect stockholders' equity and record whether they're debit or credit accordingly. So for example, revenues increase stockholders' equity, and therefore they behave consistently with stockholders' equity. If a revenue, we generate a revenue, we're going to credit the revenue account, which is because it's eventually going to increase our stockholders' equity through the retained earnings account. Expenses and dividends, on the other hand, are going to decrease stockholders' equity, and if we want to decrease a stockholders' equity account, we have to debit it, and that means those expenses and dividends are going to have debit balances, because when we increase an expense with a debit, that is decreasing the stockholders' equity with that debit. When we increase a dividend, we're decreasing the stockholders' equity. And so the debits and credits behave opposite for the expenses and dividends from the stockholders' equity accounts. This summarizes those normal account balances then. Assets have debit balances because they're on the left side of the equation. Liabilities and equity accounts have credit balances because they're on the right side of that equation. Revenues increase stockholders' equity, therefore their balance is consistent with stockholders' equity, so they have a credit balance. Expenses and dividends decrease stockholders' equity, therefore their behavior is opposite of stockholders' equity, and therefore they have debit balances. Now, if working this out in your mind is too difficult at this point in time, you can also just memorize that the debit accounts are the expenses, assets, and dividends. I often tell students, remember the word dead because you wish accounting were dead. And so that helps you to remember that the debit accounts are expenses, assets, and dividends. and that means that the liabilities and retained earnings and revenues and capital stock accounts are all credit balances because they are not expenses, assets, or dividends. So just a helpful, hopefully helpful tip for you for memorizing that. Okay, so let's go through the same transactions that we looked at earlier, but using the idea of now posting them into general ledger accounts according to the debits and credits. So when we issue capital stock, we're going to affect two different accounts. One is the cash account and one is the capital stock account. Cash is an asset, and when we issue capital stock, we receive cash, therefore we're going to be increasing the cash. Because cash is an asset, it's going to increase with a debit, and therefore we're going to see the $100,000 that we received from Karen and Kathy are going to increase that cash account with a debit entry. We're also increasing our capital stock, the contributed capital for the organization, and because capital stock is a right side equation account, it's going to have a credit balance and increase with credits, and therefore we're going to see $100,000 credit entry to the capital stock. Both of these accounts are increasing. Notice that cash increases with a debit, capital stock increases with a credit. And that's because of the accounting equation and the fact that we're keeping it in balance. Next, we exchange a note payable for property, which was made up of building and land, as if you recall our earlier example. And so we're going to show the increase in the building account. A building account is an asset, and therefore it has a debit balance and increases with debits. So we're going to debit the building account for the $150,000 value of the building. We're also going to increase the land account for the $50,000 value of the land. Again, land is an asset account, and therefore it has a debit balance and increases with debit entries. Because notes payable is a liability account and liabilities are on the right side of the equation, they have credit balances and increase with credits. So to record the increase in notes payable, we record $200,000 as a credit to notes payable. Notice our total debits still equal our total credits in this entry, so our journal entry balances and we're satisfied with it. Next, we acquire equipment on an open account, which is accounts payable, as we discussed earlier. In this case, the equipment is an asset account. The equipment is increasing, and to increase an asset account, we debit it. So we are going to record the $20,000 as a debit to equipment. Accounts payable is a liability account, which is on the right side of the equation. Therefore, it has a credit balance, and to increase accounts payable, we credit it for that $20,000. Again, our debits equal our credits. We're keeping that accounting equation in balance, and everything should be working well. When we sell monthly memberships on account, accounts receivable is an asset account. That asset we said was increasing when we analyzed this transaction before. And so we're going to record a debit to the accounts receivable for the $15,000 that the customers owe us for those memberships. We're going to record the membership revenue as a credit entry because revenues increase retained earnings, which is an equity account, which is on the right side of the equation. Therefore, it has a credit balance and increases with credits. And so we've got the $15,000 credit there. Again, our debits and our credits within this entry are equal, and therefore we can go on. Now, keep in mind that the T accounts that we're using are reflecting the general ledger accounts, which will accumulate all of the balance of any given account. So our cash account already has that $100,000 in it that we recorded when we received the investment from the owners. And so now we're selling court time for cash. We're using the cash account and the court fee revenue account. And our cash account we see already has some cash in it. when we're recording the entry then for selling the court time, we're going to add additional cash of $5,000. Cash is an asset on the left side of the equation, therefore it increases with a debit. And our revenue is something that increases retained earnings, which is on the right side of the equation. Therefore, it has a credit balance and increases credits. And so we're going to credit the court fee revenue account for $5,000. Next, we've got wages and salaries that we're paying. Again, the cash will already reflect the entries that have already been made in it. Now we're going to be decreasing cash for the payment of these wages and salaries. So we're going to credit the cash for the wages amount, which was $10,000. And notice then that because cash is an asset and has a debit balance, it decreases with a credit. Wages and salary expense decreases retained earnings, therefore it behaves opposite of retained earnings. Therefore, it has a debit balance and increases with a debit. So here we're increasing the expense account and we're decreasing our cash by debiting the expense and by debiting or crediting the cash. Eventually, this expense will get closed into retained earnings, debiting retained earnings, which decreases retained earnings. Next, we pay utilities. That's going to behave the same way as that last example. So we're going to debit the expense account and credit the cash for the $3,000 in utility expense. Next, we collect accounts receivable, and keep in mind that our accounts receivable already has a balance in it from when we sold the memberships on account. And so now we're going to collect part of that. When we collect that, we're going to increase our cash. So we'll debit our cash, and we're going to decrease our accounts receivable. So we'll credit our accounts receivable. Both of these are asset accounts. So when we increase an asset, we debit it, and when we decrease an asset, we credit it. So we're debiting the cash and crediting the accounts receivable. Next, we pay dividends. Our cash is again going to decrease, so we're going to be crediting our cash. Dividends is an account that is a subcomponent of retained earnings. It decreases retained earnings when it increases. To decrease retained earnings, we would debit the retained earnings, since that is a right side account that would increase with right side entries, which are credit entries. And so the dividends account is going to have a debit balance and increase with debits, which will then lead to decreasing the retained earnings account. So we're going to debit the dividends, and we're going to credit the cash. Okay, so let's try some examples. First, we're going to provide services to customers for cash, and in this case, that's going to result in debiting cash for $4,300 and crediting revenues, service revenue specifically, for $4,300. We're increasing the cash with a debit, and we're increasing the service revenue with a credit, because assets are debit balance accounts and revenues are credit balance accounts. Commercial break. The name of the cartoon character Charlie Brown's dog is Snoopy. Okay, another example. Here we're going to purchase office supplies on account for $1,000. Office supplies is an asset account. We increase assets with debits, and therefore we're going to debit the office supplies account. On account means that we didn't have to pay for it yet, so now we owe some money to the supplier of these office supplies. We call that accounts payable. Accounts payable is a liability account, which is a right side account. Therefore, we're going to increase the accounts payable with a credit entry. So we put in the accounts payable and we credit it for $1,000. That has the effect of increasing our asset called supplies and increasing our liability called accounts payable. And notice that our system stays in balance because the debits equal the credits. In what non-speaking Spanish city would you non-Spanish speaking city would you find the Spanish Steps? Those are actually found in Rome. Looks like a beautiful place. Okay, June 15th, we issued additional shares of common stock for $6,000. Here, that means we're receiving cash, which is an asset account, and to increase an asset account, we debit it. So we're going to first record the cash increase. Next, we're going to show the common stock increasing. Common stock is an equity account, which is a right side account, and therefore it increases with a credit entry, and therefore we're going to credit the common stock account for $6,000. Another commercial break. The purpose of the 1991 Gulf War was to liberate Kuwait. Which looks like another beautiful place. Okay, next we're going to look at posting journal entries into the T account. So if we had made the journal entries in an actual journal instead of just posting them right into the T accounts, we would see the journal looking something like this. And so we see the cash that we received for the stock and the rent expense that we paid for cash and equipment that we bought for cash. Posting these into the accounts, then we would simply take each part of the entry and put it where it goes. So we would simply take that $8,000 down to the cash account as a debit. We would take the $8,000 down to the common stock account as a credit. We would put the rent expense debit into the rent expense account. We would put the cash credit into the cash account. We would put the equipment debit into the equipment account, and we would put the cash credit into the cash account. Now the equipment, common stock, and rent expense each only had one number in them, so we don't really need to total those. But the cash account, notice we need to total that. We take the debits and we subtract the credits, and we end up with a balance then in that cash account of $4,500. Uranium, when it has lost all of its radioactivity, becomes lead. Okay, the next component of our double entry accounting system that we need to talk about is the trial balance. And the trial balance, don't confuse this with a chart of accounts. They each do list each account, but the difference is that a chart of accounts is simply a list of the account numbers and names. The trial balance also includes the dollar balances at a specific point in time. The purpose of a chart of accounts is simply to give you sort of an index of what accounts the company uses and what numbers they are, not their dollar balances, but the account number that we assign to it. The trial balance purpose is to show whether our total debits equal our total credits, because if they don't, then we've done something wrong in the system, and we don't want to make financial statements yet until we find the error and fix it. We usually prepare them at the end of the accounting period, and we use them then to prepare our financial statements. So here's what a trial balance would look like for the company that we've been using as an example. And so we would simply show all the account balances after the time period is over. For this company, it's after the first month, so we're at the end of the first month, and we're showing the snapshot of what they look like at the end of that month. And so we list all the asset balances as debit balances, the liability accounts and the equity accounts, and the revenues are listed as credit balances, and then our expenses and dividends are listed as debit balances. And all of our debits add up to $340,000. All of our credits add up to $340,000. So we are in balance, and it would be fine to go ahead and make the financial statements for this company for January. Okay, so now you try it. Here's some accounts that have balances. Use these to then make a trial balance. Now keep in mind, a trial balance is an internal statement. It's not prepared for our external financial statement users. It's just prepared for our own sake so that we can make sure that our debits equal our credits. But we will still put a title on the statement, and we'll also put the date that it's for. And then we simply list out all of the accounts that are on our chart of accounts, and then we put in the total debit, or we put the debit heading and the credit heading, and then we place the account balances where they belong. So our cash balance is a debit balance account, so we list it there. Accounts receivable is a debit balance, so we list it there. Supplies is a debit balance. Equipment is a debit balance. Accounts payable is a liability, so it has a credit balance. Common stock also has a credit balance. Revenues also have a credit balance. And expenses have a debit balance. We then add up the total debits, and we add up the total credits. Now this example is a little bit easier than what you would likely see because they gave you the balances in the T accounts. You should also make sure that you're able to do a trial balance if all you have is a list of accounts and the dollar value of their balances, but it doesn't show it on a debit side or a credit side of an account, just to make sure you also can do that. Okay, that's it for Chapter 3. So we will also we will address any questions that you have from any of Chapters 1 through 3 on Tuesday next week in preparation for getting ready for the exam that you have next Thursday. Thanks for your attention, and I look forward to seeing you next Tuesday.